A brand that turned yoga pants into a status symbol is suddenly learning a brutal lesson. Premium is earned every single season. After a rocky second quarter, guidance cuts, and an inventory overhang colliding with new U.S. tariff realities, Lululemon finds itself at a crossroads. The company lost roughly 15 to 18% in a single session and is now down nearly 50% for the year. Its market cap sliced to about $20 billion. Can the company that helped invent modern athleisure regain its rhythm without sacrificing the premium playbook that built its empire? Welcome back to the Capital Navigator, the show where we reverse engineer business empires, pressure test their strategies, and figure out what the numbers actually say. Today we're diving deep into Lululemon, its origin story, its premium machine, the stumble that's punishing the stock, and the plan to claw back momentum. We'll map the business, explain the moat, and then confront the tough stuff. Product fatigue, tariffs, inventory, and the derating that crushed valuation multiples. Let's begin. How a yoga studio became a global uniform. Every great company starts somewhere, and Lululemon's story began in an unexpected place, a yoga studio. 1998, Vancouver, Canada. Lululemon starts as a small design studio and evening yoga space, founded by Chip Wilson. Wilson's vision was to create a community hub for women to discuss fitness, health, and what they wanted in athletic apparel. The brand's origin story is deeply rooted in this community-focused approach. The first Lululemon store wasn't just a place to buy clothes, it was a yoga studio by day and a design space by night. This allowed the company to get direct, real-time feedback from its target customers. This immediate and intimate connection with its audience was a key differentiator and a significant factor in its early success. It wasn't about mass production, it was about creating high-quality, specialized products that a specific, dedicated community would love. This approach led to the development of its iconic Luon fabric, a blend of nylon and lycra spandex that offered exceptional comfort, stretch, and shape retention. This fabric became the company's secret weapon. It wasn't just a new product, it was a new standard in activewear. In 2000, it opens its first standalone store. By 2007, it's public on NASDAQ after an IPO that raised $327 million. Not without controversy. In 2013, a quality recall collides with questionable remarks from the founder. He exited the chairmanship, and some bad investments. In 2020, Lululemon bought Mirror for $500 million to ride at-home fitness. The thesis didn't hold. By 2022, the company booked a $442.7 million impairment. And in 2023, it stopped selling Mirror hardware. Instead, Lululemon signed a 5-year content partnership. Peloton supplies digital fitness for Lululemon Studio subscribers, and Lululemon becomes Peloton's primary apparel partner. The company evolved into a global performance brand spanning run, train, and everyday movement, with women's and men's lines that defined a new category of wear it to sweat, keep it on to live. From day one, Lululemon's cultural DNA is unusually explicit. Values like responsibility, courage, connection, inclusion, and fun. And a purpose to elevate human potential by helping people feel their best. That clarity fuels a community-driven brand. Educators on the floor, yoga classes in stores, local events, and ambassadors who model the lifestyle. The result is stickiness most apparel brands envy. What they sell. Lululemon's business model is a masterclass in modern retail. It's an omni-channel powerhouse that seamlessly blends physical stores with a robust e-commerce platform. The goal is simple: provide a fluid, consistent, and engaging customer experience, regardless of where or how they shop. Lululemon is a technical athletic company, designing, distributing, and retailing performance apparel, footwear, and accessories. What began as yoga-centric has become a diversified portfolio aimed at run, train, and everyday performance across women and men. Women's remains the engine, contributing approximately 63% in 2024. Men's has grown to approximately 24% in 2024, with staples like ABC pants and Pacebreaker shorts anchoring the franchise. Footwear is newer but strategic. Women's shoes launched in 2022, men's in 2024, to extend the brand's performance story from head to toe. Accessories, from yoga mats, bottles to bags, round out the ecosystem. Together, footwear plus accessories contributed roughly 13% of revenue in 2023 to 2024. At its best, Lululemon is selling a product plus experience. Technical garments designed to be lived in, taught by trained store educators, reinforced by in-store classes and community, so the shopper doesn't buy leggings, they buy a habit. That positioning allows premium pricing. Yes, approximately $100 leggings, with minimal discounting. This is a direct-to-consumer business at scale. Lululemon operates approximately 770 stores across 25-plus countries, and those locations do more than ring sales. They host classes and events and act as omni-channel nodes for online orders. The company's e-commerce business is highly efficient, accounting for a significant portion of its sales. The online platform mirrors the in-store experience by offering detailed product information, styling advice, and an easy-to-use interface. This dual-pronged approach has allowed Lululemon to capture a wide audience, from those who prefer the tactile experience of shopping in-store to the convenience of buying online. Because the model is built around product plus experience, shoppers are trained to value fit, feel, and function over discount cycles. That's how Lululemon sustains premium pricing. In short, the formula is elegant. Wrap technical product in community and service, control distribution through DTC, and price accordingly. When it works, it creates a flywheel of loyalty, full price sell-through, high margins, reinvestment and innovation. When it stumbles, the same logic works in reverse. Fast. This is the base for its competitive advantages. Brand plus community. It nurtured a quasi-tribe that turns customers into loyalists. Proprietary innovation in materials. Lululemon's library, Luon, Nulu, Everlux, Luxtreme, advertises softness, support, breathability, and wrinkle resistance. With its own lab in Vancouver where scientists, materials engineers, athlete testers keeps the pipeline fresh and performance anchored. Pricing power. Historically, gross margins sat in the mid-50s to high 50s, supported by full-price selling and a customer base less sensitive to promotional cadence. That premium posture is a choice. The company's growth is fueled by a few key pillars: expansion into new markets, particularly in Asia and Europe, diversification of its product line, especially in men's and footwear categories, and a continuous focus on digital innovation. The company has been aggressively opening new stores, with plans to open 40 to 45 new locations in the near future, heavily focusing on high-growth international markets like China and Europe. The numbers. Growth, then a break check. Now let's get to the numbers that are causing all the noise. For a long time, Lululemon's financials were a story of consistent, impressive growth. But the latest earnings report has brought some serious concerns to light. Top-line growth looks strong into 2024. $8.1 billion in 2022, $9.6 billion in 2023, and $10.5 billion in 2024. Gross margin improved from 55% in 2022 to 58% in 2023, and 59% in 2024. And net profit growth from $854.8 million in 2022 to $1.5 billion in 2023, and $1.8 billion in 2024. But in 2025, momentum slowed in the company's most important region, and margins came under pressure. The company reported second quarter results that were largely disappointing, which triggered the massive stock drop. Earnings per share of $3.10 beat expectations, but revenue of $2.53 billion came in light. More importantly, management cut full-year guidance again, projecting $10.8 to $11.0 billion in revenue, 2 to 4% growth versus 2024. Americas turned from engine to drag. The expectation shifted to flat to minus 1%. And leadership acknowledged something customers had already felt. Women's in North America disappointed in spring timing, color palette, and size breadth. The internal assessment was blunt. Product cycles had become too long and predictable. The brand that usually outruns the category got caught jogging in place. Then came the macro reset, U.S. tariff changes, and the removal of the minimus exemption, which previously allowed a large share of low-value cross-border e-commerce orders to avoid duties. For Lululemon, about 2/3 of U.S. e-commerce orders had shipped from Canada, leveraging that exemption. With the rule gone and tariffs up in parts of Asia, the cost structure tightened. The company estimates a $240 million hit to gross margin in fiscal year 2025, and a $320 million operating margin impact in 2026 from tariffs and minimus changes. In quarter 2 2025, gross margin fell 110 basis points to 58.5%, partly reflecting the early bite. Inventory compounded the pain. After an 85% inventory surge back in fiscal year 2022, well ahead of sales, North America had excess in slower models, forcing heavier promotions. By Q2 2025, inventory stood at $1.7 billion, a growth of 21% year over year. Discounting erodes margin and, if it lingers, risks diluting the premium signal consumers expect. The Q2 results triggered a 18% single-day plunge in September 2025, accumulating a drop around 47% year-to-date, and the company's market value was roughly cut in half from early 2024 to mid-2025 to roughly $20 billion. Across 2025, Lululemon's stock became one of the worst performers in the S&P 500. Context matters. The stock had soared for years, peaking near $400 in late 2021, fallen more than 60% from that date. But the last stretch reminded everyone that fashion cycles, cost shocks, and execution gaps don't care about history. Valuation multiples compressed violently. A stock that often traded at 40 to 70 times price to earnings through 2022 now sits around 11.4 times trailing, with enterprise value EBITDA 7, a dramatic derating from hypergrowth to moderate growth. What went wrong? Product fatigue, competition, and cost structure. Product fatigue. CEO Calvin McDonald didn't sugarcoat it. The company leaned too long on its core franchises. North American women's, historically a strength, underperformed. Product cycles got too long, too predictable. That plus a tougher consumer pulled America's sales. Competition. Premium upstarts like Alo Yoga and Viore are gaining share. Meanwhile, the proliferation of lower-priced dupes undercuts Lululemon's differentiation, pressuring pricing and forcing heavier marketing just to hold serve. Tariffs and de minimis that eroding margins. Supply chain diversification and modest U.S. price increases are on the mitigation list. But near-term gravity still applies. Inventory surged, which can be a sign of slowing demand or over-optimistic sales forecasts. Excess inventory can lead to markdowns, hurting profit margins. The comeback plan: speed, freshness, discipline. Despite the recent setbacks, Lululemon is not standing still. The company has a clear strategy to address its challenges and reignite growth. The first key initiative is to react faster to trends and test new styles. Management is pushing a fast-track process to get trends into stores faster, increasing the share of new products from 23% to 35% by 2026, and cutting lead times by up to 2 months. The practical goal? Make the assortment feel new more often, especially in North America women's, where the fatigue showed up first. Secondly, the company is doubling down on its international expansion. The clearest offset to U.S. softness is outside the U.S. Lululemon plans 40 to 45 new stores with a heavy emphasis on China and Europe. Under the Power of 3x2 plan, management aims to double revenue to approximately $12.5 billion by 2026, triple international, and double men's and digital, with approximately 200 stores in China as a North Star. Execution here matters twice. It diversifies revenue and validates the brand's universality. Lululemon is betting that these markets will pick up the slack from the maturing U.S. market. Thirdly, Lululemon is focused on growing key categories, specifically the men's segment and footwear. The men's business is a massive, untapped market, and Lululemon's goal to double this segment is a clear sign of its commitment. The introduction of new product categories and the continued focus on innovation are crucial for diversifying its revenue streams and reducing its reliance on women's yoga apparel. Finally, the company is consolidating its digital ecosystem. This means a focus on enhancing the online experience, leveraging data to understand customer behavior, and personalizing the shopping journey. Also, the mirror chapter is closed. The Peloton partnership keeps Lululemon present in digital fitness without owning the hardware or content P&L. That frees focus and capital for the apparel core, while keeping a toe in the customer's training routine. The best insurance for pricing power is brand love. Lean into the strengths that built the moat. Educators who know product cold, local events that create belonging, and ambassadors who make the brand feel lived in. With more newness flowing, those human touchpoints can convert curiosity back into full-price demand. We will need to keep an eye on the evolution of the North America sales, the gross margin resilience, inventory levels, international scale to see the effect of this new strategy. While the recent stock performance has been alarming, it's important to remember that Lululemon still has a powerful brand and a loyal customer base. The current headwinds are a test of its resilience, but the company is taking proactive steps to navigate the storm. Lululemon's journey from a single yoga studio in Vancouver to a global activewear empire won its first decade by making performance feel premium and building a community that wore the brand as a signal. The last year has been a harsh reminder that even great brands can drift. Product cycles got slow, the consumer got pickier, tariffs raised friction, and inventory got heavy. Now, Lululemon has to write a new chapter. It has to prove that it can adapt to a more complex environment. It needs to show that it can reignite growth in its core markets, successfully expand internationally, and continue to innovate at a pace that keeps its customers excited. What are your thoughts on Lululemon's recent performance? Do you think they can bounce back from this? Or is the era of explosive growth over for the company? I'd love to hear your perspective in the comments below. If this deep dive helped you see past the headline swings, hit like, share it with someone, and subscribe to the Capital Navigator for more long-form breakdowns of how great companies rise and how they reset. See you on the next one.